Current price, 5.36 US dollars. Intraday movement, plus 0.36. That's 7.21%. We are looking at a live price of 5.36 US dollars for Lithium Americas Corp, trading under the ticker LAC on the New York Stock Exchange, showing a significant intraday surge of exactly $0.36 or a 7.21% gain as of this very moment. The chart right now is painting a very specific picture. A green candle that is pushing aggressively against the upper bounds of the daily volatility range, signaling a potential breakout from the consolidation channel we have been stuck in for the better part of the last quarter. This is not just a random fluctuation. This is a coordinated repricing event happening in real time. Most investors looking at this chart today see a simple recovery play. The expectation is that Lithium Americas is just another beaten-down mining stock catching a bid because the broader materials sector is having a green day, or perhaps they believe the bottom is finally in for lithium carbonate prices. That is the comfortable narrative, that this is just a cyclical bounce. But the reality is far more complex and, frankly, far more interesting. The reality is that we are witnessing a collision between massive government stimulus finally hitting the bank accounts and a sudden violent squeeze in the underlying commodity market in China that is forcing short sellers to cover their positions in Western miners. The market expected a slow grind. The reality is a rapid acceleration of capital deployment at Thacker Pass, combined with a sudden shift in global lithium sentiment that few saw coming this week. This divergence between the sleepy miner expectation and the geopolitical energy asset reality is exactly why we are seeing the 7% move right now. Let's look closely at what is driving this price action today, Wednesday, November 19, 2025. The volume we are seeing in the first few hours of trading is already eclipsing the average daily volume of the past 2 weeks. When you see a stock like LAC jump over 7% on heavy volume, you have to look at the order flow. We are seeing significant block buying, likely institutional, which suggests that the smart money is positioning for a catalyst that retail investors might be overlooking. This isn't just about Robin Hood stock trading enthusiasts chasing a momentum ticker. This bears the hallmarks of systematic accumulation. The immediate trigger appears to be a ripple effect from the Asian markets overnight, where lithium futures on the Guangzhou exchange surged, reacting to comments from major industry players about a looming supply deficit in 2026. When the spot price of the underlying commodity moves in China, tickers like LAC in New York act as a high beta proxy, essentially magnifying that move. You are not just buying a mining company here, you are buying a leveraged derivative on the geopolitical stability of the battery supply chain. But we need to look deeper than just today's green candle. To understand why this stock is trading at $5.36 today, you have to understand the massive structural changes that have occurred in the last 30 days. We recently had the confirmation of the first drawdown of the Department of Energy loan. This was the sword of Damocles hanging over the stock for nearly a year. The expectation was that the money would come, but the reality of the paperwork and the conditions precedent was a gridlock. Now that the first tranche of that $2.26 billion loan has actually been accessed, roughly $435 million hitting the balance sheet just last month, the bankruptcy risk that bears were betting on has effectively evaporated. The market is re-rating the stock from distressed developer to funded construction play. However, this funding didn't come for free, and this is where the nuance lies. The company recently completed a substantial at-the-market equity program, selling over 30 million shares to raise the cash reserves required by the DOE. This diluted shareholders, which is why the stock was heavy in October. But now that the dilution event is in the rearview mirror, the overhang is gone. The selling pressure from the company itself has stopped, clearing the runway for the price appreciation we are seeing today. When you consider where to place your capital, you might look at Schwab Intelligent Portfolios or consider online investment strategies that automatically balance your risk. But an algorithm often misses the specific texture of a situation like this. An intelligent portfolio might see LAC as high risk due to its lack of current revenue, but it fails to account for the strategic backing of the United States government. This is where self-investing and doing your own deep research pays off. Unlike putting money into a broad investment bucket or a generic Fidelity mutual fund, buying LAC is a specific bet on North American industrial policy. You are essentially betting that the U.S. government will not allow its flagship lithium project to fail. It's a different kind of safety net than you get with Apple stock or Microsoft, but it is a safety net nonetheless. Let's talk about the elephant in the room, the relationship with General Motors. This is the linchpin of the bull case. The expectation was that GM would simply write a check and everything would be smooth sailing. The reality, as revealed in the recent restructuring of the investment tranches, is that GM is a tough negotiator. They want to see execution. The delay in the second tranche of investment was a wake-up call for the market, causing that dip we saw a few months ago. But look at the counter-narrative. GM is still fully committed to the offtake. They need the lithium. If you look at the production targets for the Ultium battery platform, they literally cannot hit their EV targets later this decade without Thacker Pass coming online. This creates a floor for the stock. It's similar to the symbiotic relationship you see between suppliers and major tech firms, like the dependence of data centers on NVIDIA stock. GM is the NVIDIA in this equation, and LAC is the fab. They are inextricably linked. If you're using Interactive Brokers or a similar Interactive Brokers trading platform, you might have noticed the options chain for LAC lighting up. The implied volatility is skewing to the upside. Traders are buying calls for early 2026, betting that the mechanical completion targets for the processing plant will start to look more tangible as we move into the new year. This forward-looking activity is a strong signal. It tells us that the market is starting to look past the construction dust and towards the actual production of battery-grade lithium carbonate. Now, I want to pivot to the macro environment because you cannot trade LAC in a vacuum. We are seeing a fascinating rotation in the broader market. Capital is moving out of overcrowded mega-cap tech trades and sniffing around the hard asset sector. With interest rates stabilizing, something you'd track closely if you use Fidelity Wealth Management or similar services, the cost of capital for massive infrastructure projects like Thacker Pass is becoming less daunting. When rates were skyrocketing, the discounted cash flow models for a mine starting production in 2027 looked terrible. Now, as the rate environment normalizes, the NPV of the project rises mathematically. This is a tailwind that doesn't make headlines but quietly pushes the stock price higher day by day. Furthermore, we have to talk about the EV sector sentiment. For a while, the narrative was, EV demand is slowing. You heard it everywhere. But look at the actual delivery numbers from China and the stabilizing figures from U.S. legacy automakers. The growth rate has slowed, yes, but the absolute volume is still climbing massive cliffs. Tesla stock remains a bellwether here. When Tesla stabilizes, the entire supply chain breathes a sigh of relief. We are seeing that stabilization now. The fear of a total collapse in EV demand was overblown, and the rubber band is snapping back. Lithium Americas is the highest leverage way to play that snapback because their entire valuation model depends on the long-term pricing of lithium in the late 2020s. I want to take a moment to ask you guys something because the retail ownership in this stock is incredibly high compared to other miners. Comment below how many shares of Lithium Americas you currently hold and what your average buy-in price is. Are you holding bags from the spin-off days, or did you load up in the $3 range during the panic? I'm genuinely curious to see where the community stands on this because the psychological resistance levels on the chart often align perfectly with where the mass of retail investors are looking to break even. Let's switch gears and discuss the project itself, Thacker Pass. It's easy to get lost in the financial engineering of Fidelity IRAs and SoFi Invest accounts, but ultimately, this is a dirt-moving operation. We are talking about the largest known lithium resource in the United States. The sheer scale of this deposit is hard to comprehend. It is a clay-based resource, which is distinct from the hard rock spodumene mines in Australia or the brine ponds in Chile. The expectation was that clay extraction technology was unproven and risky. The reality is that the pilot plant results have been robust, and the engineering design is now over 90% complete as of the last update. They are not guessing anymore. They are building. Construction is